All right, and we are live. And this week I am at one of our satellite offices, so the lighting is horrible, but it is what it is. We'll go with it. And of course, my name's Chris Berry, and we do these weekly wisdom webinars every week on Wednesdays at 1 o'clock. And it's an opportunity where if you do have questions, you can always submit your questions and we will address them live. And let me log in real quick and we should have there we go. That's what I was trying to share. All right, so we do these every week. And if you do have a question, feel free to put it in the Q&A section. It's just a time for us to get your legal, financial, and tax questions answered. Of course, this is general information. If you want to see how it applies to your situation, please schedule some time to chat to see how all of this applies to your situation. And you can either reply back to the email or go to 15chris.com or just give our office a call. And with that, I would start with a positive focus. So this week, we just started off soccer. We had a couple practices and we're having our first game this weekend for my 11-year-old boy and 8-year-old girl. So I'm coaching both of their teams. So hopefully we have a good weekend. So cross your fingers for us on Saturday. We'll be out playing. All right. So the first question I have submitted is, it's kind of a long one. Assume we have a $2 million estate. And so it's being left to a spouse, a child, and grandchild as part of a revocable living trust. And we have mutual funds and a house. In the case of the mutual funds, they're in the inherited IRAs. All right, so I always like to think of a wrapper or like an IRA, kind of like a wrapper. You can have different types of investments inside of an IRA. You could have mutual funds, which are mixtures of stocks, bonds. You can have fixed index annuities. Depending on the type of IRA, you can even have real estate inside of there. And you can even have businesses if it's a self-directed IRA. So IRA is like a wrapper. Likewise, a trust is a wrapper as well. A lot of people are like, what can I invest inside of a trust? And same thing, like mutual funds, brokerage accounts, stocks, bonds, real estate, fixed index annuities. So they're just different types of wrappers where you have specific investments inside of that wrapper. So this person says we have mutual funds inside of an IRA. So what's important about the IRA is how it's taxed. So traditional or pre-tax, meaning whenever you take money out of here, you're taxed at ordinary income tax rates. So typically at a 401k or 403b that you rolled over to an IRA. And so we're kind of outlining two situations, one with IRAs and one with non-retirement funds. So that could be like money inside of a trust. This would be what we call a taxable account, where you're potentially taxed, maybe taxed on the gains, depending on the situation. This is always taxed. So whenever you pull money out of IRAs, it's taxed. This is maybe taxed. And at most to be taxed at capital gains. Will the trust's annual tax differ? Typically, the way that we set up a trust, the trust isn't taxed at trust tax rates, it's taxed at personal income tax rates. So to answer this first question, the answer would be no, they would be taxed exactly the same. What is each trust tax rate? Again, typically what we do with the trusts, and I guess upon death, the IRA can actually go into the trust as well. I think we should clarify that. So now it becomes an inherited IRA. But so let me kind of redraw this. So now, so let's say one spouse passes away. Now we have a trust that really has kind of two types of assets. One, what I would call pre-tax. And pre-tax would be the IRA. And one would be post-tax. This would be like the mutual funds and the house. So upon death, what happens is you get a step up in basis. So this would go to the kids or a beneficiary is tax-free. The only tax in this situation would be related to this pre-tax IRA where it's never been taxed. So you're going to have to pay tax. And so it'd be taxed at the individual rate for whoever the beneficiary is. So it shows up as income. And then again, with the Secure Act, all the taxes have to be paid within 10 years. So it's not that because it's a trust or anything, that's not why it's taxed differently between the IRAs and the post-tax accounts. It's because of just the nature of what they are. Because again, at the end of the day, we have basically three tax buckets. We have taxable, tax deferred, and tax-free. So whether you're using a trust or not, how this goes to the next generation will determine whether it's taxed. So again, anything tax deferred, that's like your IRA, that's always going to be taxed. It's just a matter of when is it taxed. So no, it's not because of trust, it will be any different. What is each trust tax rate? It really doesn't matter. It's tied to the individual. Is there a state annual tax? Yeah, each state has its own annual income tax. For example, Michigan, I know, is 4.25%. Not every state has income tax, but you also have to take that into account. Is there a situation where there is an estate situation where inherited IRAs are better than non-retirement accounts? Well, if I'm a beneficiary, the first type of account I want to inherit is tax-free. So this would be things like index universal life insurance, Roth IRAs. Second best thing would be taxable accounts. And as of right now, so this would be like mutual funds outside of an IRA, brokerage accounts, real estate. Because as of right now, these are all tax-free upon death because of step up in basis. So whether it's Roth or money that's in a mutual fund and a trust, it's tax-free upon death because you get that step up in basis. But what we don't want, and what you typically don't want to, if I was a beneficiary, granted, beggars can't be choosers, you're getting money, but the worst type of money to inherit is pre-tax dollars. So again, we keep banging this drum of taxes are going up in the future. Don't think just about your retirement or the rest of your retirement, also think about what you're leaving to the next generation. So the big thing out of this is just understand that IRAs are really the last thing you want to leave to beneficiaries. And so when we're talking about spending money, like which accounts should we use first, we want to use kind of the worst option first. So start with IRAs and then spend down taxable accounts and then spend down tax-free accounts. So if you look at kind of income planning, a lot of times we're draining down the IRAs first, then the taxable accounts, then the tax-free to try to leave as much tax-free money to the next generation. So kind of complicated. Let me know if you have any questions on that. But the big thing to understand is that until we start talking about estate taxes, which right now are at $11 million for a single individual, scheduled to drop down to 5 and then to 3.5. A lot of the trusts that we use are tax neutral. Only when we start getting into estate taxes do we have to start worrying about different types of trusts. Like I met with an individual today, he has a bunch of real estate, not married, single individual, has $10 million worth of real estate. And if he were to pass away right now, there's no estate tax. But that estate tax exemption is dropping from 11 to 5 in 2025. So if he were to pass away after 2025, there might be $6 million that's taxed at 40%. So that's where we talk about some different types of trusts to remove some of that real estate from his estate. So, but the big thing, unless you have an estate tax issue, is to worry about how much money you have inside of these pre-tax IRAs and developing a strategy, getting money out. It's one of the biggest risks and biggest opportunities right now are taxes. All right. Now, the next one is not really a question. It's more of a, let's call this a hypothetical. But a lot of times as attorneys and advisors, sometimes people think we're always like doom and gloom. And a lot of people think like the worst can't happen. So here's the situation. So mom, but my point with this is that these things do happen and we see it. So let's say we have mom here. Mom's about to retire. She has her home. She has a second piece of property. And let's say she has 300,000 inside of IRA money. And let's say she has 25,000 sitting in checking savings. And let's say she has a son. Son's in his 40s, hasn't made the best choices in life, struggling to kind of get his feet on the ground, but he lives in the house, second property. So mom has a rental and her son is living on the rental, but the house is just in her name. Son's name is not on the house. And son has a large dog who he takes care of. And son invites a friend over. And unfortunately, son steps outside and the dog actually bites the woman's face. So now what happens? Well, she's severely injured because of this dog bite. And now she sues mom for $750,000. And understand that this house is maybe valued at 125,000, and then her personal residence, let's call it 300,000. But she's now sued for 750,000. So what are the options that we can do to help protect the assets? Because otherwise they might come after the rental, her primary residence, and all of her retirement accounts. So what we cannot do at this point is we cannot set up an asset protection trust because the event already happened. So that would be what's called a fraudulent conveyance. I've had, this happens quite often, is something happens and then someone reaches out and because I can't talk and write at the same time, fraudulent conveyance. Basically, it's kind of a 2-year window from when the event happened. So if you have some type of event and then you move your assets into an asset protection trust, it's not going to work. This asset protection planning has to be set up ahead of time. And really there's 2 routes you can go. So if you're planning ahead, and this is really what we focus on, is we can put together asset protection. That's planning ahead. If this situation happens and you don't have a plan in ahead, then you're looking at potentially bankruptcy. And so in this situation, we can't focus on any last minute asset protection. We have to focus on, okay, let's say that this lien, they do succeed in getting a $750,000 claim. What are your options at that point? And okay, we don't have $750,000. So now we have to go to bankruptcy court, and bankruptcy court will typically allow you to keep your personal residence, depending on the situation, and your retirement accounts. So what would be lost would of course be the rental and checking savings, and then obviously affecting the credit rating. So this is kind of a stressful option. So let's talk about what should have happened or what should be in place from an asset protection, more from a planning ahead side. Okay. What are some things that we could do in this situation? Well, first of all, whenever we have a second piece of property, we always consider that a hot asset because of situations like this. You could have a renter there and something falls on their head. Now they're suing you. So typically with second pieces of property, what we would do is what's called a limited liability company or an LLC. So now if there's something that happens because of that property, they can only take what's inside of that LLC. So in this situation, if there was an LLC around that second property, she probably would have been protected. They might have been able to take the rental, but that's all they might have been able to attach. So if you have real estate, we do a lot of LLCs for second pieces of real estate. A super easy, and everyone should be looking at this, is an umbrella policy. See if I can draw an umbrella. Yep, okay. Umbrella insurance. So this is through your property and casualty person, and I'd recommend you have at least up to your net worth, maybe even higher, especially given a situation like this. But typically, it's going to cost you from your insurance guy about $200 per year per $1 million of coverage. So if she had an umbrella policy, then that could have covered that 700. If she had $1 million umbrella policy, that would have covered that $750,000 claim. That's one of the easiest options, is just go out and get an umbrella policy, because that would have protected her. The other thing we can do is set up that asset protection trust, move those assets into the trust, and then whatever's in the trust would be protected. But these are all things that have to be set up ahead of time. We can't do any of this upon the event happening. Now we're just stuck with whatever the state rules and bankruptcy rules allow us to maintain. And like I told her, hypothetically, I'm not an expert on the bankruptcy side, but if I'm not mistaken, you can keep your primary residence and then up to $1 million of 401k, IRA money under different rules, but basically retirement accounts. Also, you can keep cash value life insurance, like index universal life. So all of those are, if I'm not mistaken, protected against bankruptcy. Where we really focus on is the planning ahead side. So, which if we could go back in time in this hypothetical situation, we should have had that rental in an LLC. We should have had more umbrella policy, and then maybe we have that asset protection trust with the LLC actually inside of the asset protection trust. So my point with this is, like, these things happen. We always imagine that it won't, but we can't ignore that the stuff happens occasionally. So, and once it happens, we can't go backwards. Really have to focus on the planning side versus just the crisis side. So, all right, that is all. Oh, here's a chat. Let me pull this up. All right, where can I pull up the chat? Here we go. Here's a question. And let me share my, make sure I'm sharing my screen as I look at the chat. And where did the Zoom go? Hold on. Here we go. Sorry about that. All right, here's a question came in. And again, if you do have any questions, please put that in the Q&A, because this is the last thing I have submitted. And it's asking about step up and basis. Will step up and basis survive now that Biden and $3.5 trillion plan is at risk or maybe diluted, negotiated? All right. Yep. So real quick, step up and basis. And this is how I was explaining to a client today. Let's say you buy a piece of property for $1 million. Number of years go by. Now let's say it's worth $2 million and you've passed away. And then the kids sell it for 2.1 million. So what tax would be due? And again, this is in a taxable account. So we're taxed on our gains. So we have to worry about the gains here. So is it from the date of death till the kids sell, or is it from when you purchase the property versus when the kids sell? Well, at death, you get what's called step up. And this is another reason why we don't do joint ownership. Where it came up in context with what I was talking about today is a gentleman was asking, well, if I transfer my real estate, or if I use joint ownership to transfer my real estate, what are the consequences? I was like, well, you avoid probate, which is what you want to do, but you lose the step up in basis. Where now, if the kids sell with step up in basis, where it's in your name when you pass away, either through a trust or a ladybird deed with real estate, then they would only pay $1 million or $100,000 of gains. versus if we lose that step up in basis, now the kids are looking at $1.1 million worth of capital gains that they have to account for. Because right now we have step up in basis, meaning when you pass away, anything in that taxable account gets brought up. The basis is now that dated death value. And now if the kids sell it like a year later and it's grown a little bit, that's all the tax they have to pay. Versus in this situation, if you purchased it for $1 million and then you die and the kids sell it and we don't have step up in basis, because remember, joint ownership does not give step up in basis. That's why one of the reasons why we don't do joint ownership to transfer assets. But also what President Biden is proposing is, and this is what I call a stealth tax, is because people, A, don't really always realize how basis works, and B, if they hear about it and they don't really know, it's not gonna be a big deal. But they're talking about getting rid of step up in basis. So that's going to affect anything that's sitting in these taxable accounts. Okay, again, we have taxable, tax deferred, and tax free. So already we know that taxes are going up, which makes the value of this passing it to the next generation worse. But now, depending on the size of your accounts, that might be a problem too. So again, that's why with a lot of our clients, we're focusing on strategies to get as much as we can filled into that tax-free bucket. So the question is actually, will this get through? I don't know. It's kind of getting stalled up. And a lot of people think it's just being used as a negotiating tactic because think about it, like if your family bought like a farm in 1920 or something like that, how do you know what the fair market value was or what the basis was? It'd be something kind of hard to just administer. So I'm not sure if it'll pass. We're kind of watching how this year goes, and it's been a strange year. I think everyone would agree. So I don't know. We don't know if that step up in basis will remain or if that will be repealed. All right, and any other questions? Going once, going twice. All right, sold. All right, make it a great week. Wish me luck on Saturday. Hopefully my boys and girls win. Take care. Bye-bye.